Hello and good morning. It's January 4th. It's Friday. It's the end of the first shortened week of the year, a week that has been very tumultuous. We've seen some sharp moves across the board. It seems, though, as though we are maybe heading towards a little bit of calmer water as we head towards the weekend. The market focus is once again shifting towards trade talks between US and China, which is really a very key driver for the markets and the nervousness we've seen in recent weeks and months. So if we look at the first chart here, we can see the S&P. It's still we've seen this weakness this week, but we are trading a bit higher today. The market is pinning their hope on the trade talks, showing some signs of progress. There is no doubt that the weakness we've seen in the US, we saw the profit warning from Apple yesterday, the first in 16 years. It's also I think the US is probably also more prepared to find some common ground. So that's what the market will be focusing on. Also in Japan, we had this huge move in yen yesterday. We've seen Japan return today after a long holiday, and that has we've actually seen the yen seen some renewed weakness. We can see that on the chart here, which is the Aussie yen. And again, Aussie yen is quite often being used as a proxy for growth in Asia, and after that very sharp move lower yesterday, it has recovered, and Aussie yen is trading higher today. So also a sign that the market is pinning their hopes on some news on Monday from the trade talks. We also seen high-grade copper returning from the abyss. It almost broke some key technical levels. We are trading a little bit higher today, so that's also adding some easing some of the tension in the market. What has really been we've seen a significant change in the outlook is if you look at if the market expectations for Fed funds for increase in rates this year. This is the 1 month Fed funds curve, futures curve, and the purple line, the top one is how the market looked at future rate hikes a month ago, and you can see the market was looking for rate hikes all the way towards the beginning of 2020. Since then, we've seen a complete collapse in this forward curve, and right now, if you look at the implied, the market has gone from expecting a quarter point hike in 2019, and now they're looking at a 50% chance of a rate cut, and a cut in 2020 is now fully priced in. So this basically leaves the market. You can almost argue that there's so much bad news priced into the market that we could potentially see some relief coming in. And today's job report later in the US potentially could be the driver for this. So the sentiment is weak, but it's so weak that we have this risk of recovery. If we look at the market, which has really done quite well here at the beginning of the year, probably one of the best performing, it's gold, and we have been challenging $1,300 overnight. The future has been briefly through. We're trading a tad lower now. I think we have to note that the 14-day RSI is at a 3-year high, so the market is really in need of consolidation. And if we should see some of the other markets stabilize, then gold potentially could see some weakness here in the short term. Just taking a look at the table on the right, because what is the reason for this strength we've seen in gold? If we get back to the chart, we can basically see these are some of the major drivers for gold. We can see the currencies this is the moves over the last month, and we can see the currencies. The dollar is generally weaker against dollar index, yen, and Chinese yuan. That's positive for gold. In yields, we've seen yields in anywhere from Fed funds all the way out to 10-year drop as well. That's also gold positive. We've seen stocks come off quite significant. Again, that's gold positive. The only really thing that hasn't been supportive is the general commodity trend, which has been negative due to the sell-off we've seen in crude oil. But overall, we've seen the ETF holdings rise quite strongly. We've seen the hedge funds returning to the futures market. So at this stage, as long as we continue to see these movements, gold will continue to trade higher. But as I said, in the short term, we may see some risk of some reversals here because we may see some easing of the tension, at least until early next week when we have some news from the trade talks. I'll just show you the oil chart as well, because even though it's been a week with quite a bit of negative news, it's actually heading for its best weekly gain since June. If you look at the chart here, we can see we are still stuck here between 50 and 57 on Brent, but we are starting to challenge the higher end of that range. Today the market will be focusing on the weekly stock report. And we are expecting a drop in crude oil of in the region of 3 million barrels. The API reported an even bigger drop last night. And if we look at gasoline and distillate stocks, if API is correct in their big forecast for rises, that could potentially start to reduce some of the refinery demand. But we'll have to take a look at those numbers as they come out. It's later in the day. But overall, the reason why oil has recovered so strong this week is response we've seen from OPEC in last month. Yesterday, oil market reports or the oil service, both from Reuters and Bloomberg, pointed towards a sharp reduction in crude oil production from OPEC in December, and that's even ahead of the official agreement or accord to cut production from January and onwards. So that's help creating a flow in the market. So keep an eye on 57 in Brent crude. And just finishing off on the commodity space, which is obviously my key area, we can see that it has been a reasonably strong week, led by energy. You see the blue bar, and also grains. In grains, we got two stories right now. We got wheat, where US wheat is starting to reach a level where it's started to become competitive with wheat sourced from other regions, especially from the Black Sea and Russian wheat, and that's starting to attract some potential increased export demand, and that's obviously what the market needs after a bumper crop. They need to get the stocks down, and that will support the price. The same thing goes for soybeans. Chinese are continuing to buy US soybeans after the agreement last month between the US and China in Argentina. And also we have some weather concerns in Brazil, which could potentially could reduce the crop there. So that's why we're seeing wheat, soybeans, and with that also corn trading higher. I mentioned the unemployment report today from the US. That's obviously key, but also we have quite a special session with the two former and one present Fed chairman. If you look at here, we can see that Neil Irwin, which is the chief economic correspondent from the New York Times, he will be interviewing these three later today at 3:15 GMT. And with all the focus on the FOMC and the Fed, clearly this could be quite an interesting interview, and it could provide some clues as to the thinking of the Fed at this stage following the recent turmoil, and also some of the weakness we've seen in data, especially this week. Okay, let's finish off with the table. There's a lot of stuff going on today. I will just highlight the average earnings and the job report in general from the US later today, and the interview as I just mentioned. And also on the energy front, we got delayed storage report, both covering natural gas and crude oil. Okay, that's it. I'll finish off here. As I said, the market is very depressed. There is a potential the risk of some relief this afternoon following the job report, but and the interview. But plenty to look forward to. Otherwise, we'll be back again same time on Monday. Thank you.